Good afternoon, everybody. My name is Kevin Marsden, and I'd like to welcome you to our webinar today. The host of our webinar today is Herb Morgan. Herb is the Senior Managing Director and Chief Investment Officer of Efficient Market Advisors, a business of Cantor Fitzgerald. Herb has been interviewed by multiple publications, including Forbes, CBS MarketWatch, Business Week, Investment News, Investors Business Daily, and the Wall Street Journal. He is a regular guest commentator on CNBC television. He has served as an expert witness in cases involving mutual fund, trustee, fiduciary liability. Herb has served as the president of the Board of Administration of the San Diego City Employees Retirement System, where he was a member of the Investment, Business and Government, Audit and Disability Committees. He was a member of the SD-CER's Board of Administration from April 2009 to July 2013. Herb graduated with honors from the University of California, Santa Cruz with a Bachelor of Arts in Economics. And with that, I'd like to turn over this webinar to Herb. Thank you very much for joining us.
Well, Kevin, thank you for having me, and Ellen Miller, thank you for the invitation. I really appreciate the opportunity to speak to everybody today. Very interesting times we're living in. I don't think in 33 years of managing money, you've seen me at my desk without a shirt and a jacket and tie, and here I am in a ball cap. We are, like all of you, I'm sure, shut down. We're an essential service, so there's two of us that come in. The other one is my son, who's a portfolio manager here, and we spread out across the office, and all the rest of our employees are working from home. We have several in New York City, of course. They're working from home as well. But for sure, our activity levels have been very high the last 30 days. Unlike many businesses, which are essentially the activities are low, levels are low. Obviously, we're open and fielding a lot of calls and requests for presentations like this, which I'm very happy to do to try to kind of get some of the economic information out there that relates to the health situation that we find ourselves in. So let's go ahead and get started. Since you all are lawyers, you're familiar with these things. My legal department wants me to remind you that this is for informational purposes only. No part of this presentation should be treated as investment advice. There are no recommendations for the purchase or sale of securities. That being said, I'm sure all of you have done the one thing you probably shouldn't do, which is log into your 401k or your SEP account last couple of weeks and check on the values. Through yesterday's close, some of the broad indices that you're probably familiar with are down substantially. The S&P 500 has recovered quite a bit. In fact, it's up 20% from the recent lows in March, just last month. But small and mid-cap companies have only recovered a fraction of that amount. So they're still down considerably. It seems like the highest quality, the biggest names are getting the first wave of relief as we begin to see some evidence of curve flattening around the world. Clearly, markets tend to be leading indicators. What that means is markets will start to behave well far before the economy gets well. You know, you might look at it and say, well, gee, I'm looking out here. These streets are empty out of my office. The Starbucks is shut down across the way. We all know this. Yet the markets are going up big the last couple of days. And that's the reason why markets tend to be predictive rather than reactive. And markets can be a very good indicator of how things may be developing. That being said, they can also turn pretty quickly and head the other way. In fixed income land or bond land, you can see the aggregate bond index. That's the most common measure of bond returns, is actually up for the year. That's because it's capitalization weighted, and the vast majority of that index is government securities and agency securities. It's about 65%. That's just how big the government bond market is in our country. Because of that, when you have a time of stress in financial markets, the capital immediately flows out of risk assets and into the safety of that AAA rated government guarantee or the implied guarantee that you would see from the agencies. And as you would expect, corporate issuers are down. You can see the high yield bond index down about 14%. Even the highest quality short-term bonds are down ever so slightly. And the 20-year Treasury index, yes, that's correct. That's not a typo. It's up 24% since the beginning of the year. And in my mind, it was overvalued at the beginning of the year. That just tells you how significant and serious this has all gotten. Bottom line is we are in a bear market and we are in a recession. There's pretty much no doubting that. There isn't an economist on the street that says at this point we're going to skirt a recession or a bear market. We're certainly in one. There's three types of bear markets. We typically define a bear market as a decline in the stock market of 20% or more, and a correction is a decline of 10% or more. The three types of bear markets, the first one is structural. Structural is caused usually by a big economic imbalance in the system. If you think back over the last 20 years, we had the dot-com bubble in 1999, but it was not just dot-com stocks. All stocks were valued at stratospheric multiples. Economic thinking was clouded that the business cycle was over and we'd never have another recession again, and it justified higher valuations on companies. That's a bubble. The real estate bubble of late 2007 is a bubble. This big imbalance, these big imbalances tend to unwind very slowly. So you can see the average decline is about 60% over 42 months. It's a long, grinding, brutal bear market. Causes many investors to say, well, maybe I just never should have invested, and they sell out of their portfolio. And of course, they usually end up being disappointed, but they typically recover over about an 111-month period. That's a very, very, very long time. The second type is the cyclical bear market. Cyclical bear market is caused by the Fed, usually by the Fed raising interest rates to prevent inflation. In this country, if you're my age, you grew up with the fear of inflation because you experienced it early on, that back in the 70s and the 80s, inflation came, it was terrible, it was devastating, it was destructive. And so the US Congress passed legislation in 1979 that said the Fed's job is to make sure our currency value stays stable. And it had become unstable after we went off the gold standard, right thing to do, but now we had to take action to make it a stable value currency over time. They've been successful at that, and the way they were successful is every time prices started to creep up, they took action to raise rates to slow economic growth to prevent that inflation. In the past, that inflation was usually caused by energy prices. The dominance of OPEC in our economy for the last 35, 40 years has been very significant. Today, that's not the case, so we're not going to see as many of these cyclical bear markets. Still, the decline there is not quite as bad, averages 31%. Over 27 months, it's quicker, much quicker, and the recovery period is less than half of that. The third type of a bear market is one that we're experiencing now. It's caused by an exogenous shock. The American economy was in better shape than most every major G8 or even G20 economy in the world in terms of its productive capacity, its growth rates, its utilization rates of resources, et cetera. It was in really, really good shape as recently as 5 or 6 weeks ago. But when you have a sort of lightning bolt out of the sky shock to an economy, it can cause a pretty severe market dislocation, the average of which is actually the smallest of the three types. It's 29%, and we got more than that. It tends to last for about 9 months from peak to trough. We got peak to trough in a matter of weeks, assuming that trough from 2 weeks ago is the bottom. And they also tend to recover the most quickly or the quickest. So does that mean this pattern in the future will be exactly like the pattern in the past? Of course not. All we can do is look at those past patterns, try to use some good judgment and our intellectual firepower and try to ask what this one's going to look like. We also can look in the past and say, this one's unique. What's unique about it? Well, one of the things that's unique about it is we've never had an exogenous bear market shock that was triggered by a global pandemic, a disease outbreak, if you will. We also have never had an exogenous shock where we didn't have a lot of firepower in our interest rate mechanism, that the Federal Reserve could just come in and say, well, I'm going to lower interest rates, that'll stimulate and it'll make up for that shock. Our interest rates were very near to zero when this happened. Still, we lowered rates, we got that done, and other programs, which I'm going to show you in a minute. But these two things would be, if you were sort of looking at this from a negative view or a glass half empty view, you would really point to these like, hey, this is different. We've never had this before. And you wouldn't be wrong. We do know that when we did have the markets roll over, not nearly to this extent, but like we did have some impact in SARS, the equity markets began to rally aggressively before the economy improved. And it was coincident with the flattening of the curve, the deceleration of the rate of infection and the deceleration in the rate of death, that second derivative, or you can look at a logarithmic chart for those of you that are so inclined. And I'll show you some of the, matter of fact, I love this Zoom. Let me just give you a current one. This is Corona virus U.S. confirmed cases. And when you do a regular graph, this is, you think this is just horrific. And why is the market, starting to do better? But then you change it to a logarithmic, which measures percentage increase. And you can see that the percentage increase, which had been accelerating in March, is now decelerating on a daily basis. And that is happening in places like France and Italy and Spain as well. And that's why the markets are giving us this little relief rally. And you've seen your 401k go up now for a little bit of time. But again, I just want to reiterate if how strong the economy was. If you were going to take a body blow like this, which is what our economy has done, you'd want to be in as best shape as you possibly could be. Think of it as a in a coronavirus analogy, right? You don't want to be with a compromised immune system in a nursing home fighting off the effects of a disease or diabetes or something like that. You want to be physically fit, prime, in the best shape you can be in, and that's kind of where the economy was. If you think about it, just 2 months ago, we had back-to-back months of 273,000 jobs, thankfully. We had real wage growth, which is wage growth after inflation, so that the real purchasing power of American workers was actually increasing, meaning baseline quality of life was increasing. That's not to make a political statement at all about the high lows and those discrepancies, but the bottom, the wage growth was actually increasing net of inflation. The service sector, which represents about 86% of our economy, I had a reading of 57. Now the scale here is 50 is no growth, below 50 is deterioration, above 50 is growth. When you start getting above 55 to a 57 reading, your service sector is really accelerating, and it's coincident with very strong economic growth. That was February. The manufacturing sector, which is about 13% of the U.S. economy, that had been in a pretty big funk for all of 2019, with readings in the fourth quarter below 50. And the reason for that was the disruption to the supply chain last year, international trade, that was related to the U.S. renegotiating its trade policies with some big partners, Canada, Mexico, and China, Japan, and South Korea. Those agreements had basically been solidified and were sort of on deck for January of 2020. And sentiment in the manufacturing industry was actually going higher and had gotten above 50 in February. So we were all looking at this going, all right, what's GDP going to be? We're going to get greater than 3% GDP growth. That was the baseline estimate for almost every firm on the street, including mine, 5 weeks ago. And obviously, I don't know if you all, hopefully nobody remembers, but I'll just mea culpa here. I was doing a CNBC interview in January, and they asked me about coronavirus impact. And the data that we had, we had read up on it, we had researched it, but it all came from the World Health Organization. And the World Health Organization said, this is a non-event. All the things you heard people saying about it's fine, it's contained. And of course, nothing could have been more inaccurate. And so we thought back then that this would pass quickly, far more quickly than obviously it actually has. We had all of the four stools necessary for strong economic growth in place 5 weeks ago. We had a central bank that was not raising rates. They were in fact cutting. They had already cut a little bit. We had a tax policy where, because of the Tax Cut and Job Act of 17, we had gone from a 35 to a 21% corporate rate. We had the pass-through 20% exemption. You had the accelerated depreciation allowance. All of these things will accelerate your economic growth rate. You had a regulatory policy that favored growth maybe over some other objectives within the regulatory framework, also would contribute to growth. And then finally, what was added late in 19 was the favorable trade policy. So again, you look at the checklist. I've got the recipe. I've got everything here. I'm about to bake chocolate chip cookies. I've got my eggs, my flour, my chocolate chips. I got the oven. I've got the pan. I've got everything. And you're just about to put those cookies in the oven, and then the oven blows up on you. And that's essentially what's happened here. What's different in this economic crisis from the 08-09 financial crisis is two things. Number one, it's the scale of the response, the size of it. And number two, it's the rapidity, that how fast globally governments and central banks have responded to the crisis. Give you an example. Back in 08 and 09, this started to happen in the fall of 07. We kind of knew we were in trouble at the beginning of 08. And it took months of infighting and back and forth. Is it a problem? Is it not a problem? If you remember, the chairman of the Fed at the time said, it's largely contained. Should we let systemically important financial institutions fail? We let Lehman fail, AIG, all of these companies. And the only response was in the early spring, about this time, we had a $150 billion fiscal stimulus package that the White House at the time supported, was able to get through Congress. But that didn't do a thing. It didn't do a thing. This just ground on for about 18 months. 4 of the 5 calendar quarters in that 18-month period had negative GDP growth. It was very, very difficult time to be a money manager, I can tell you that. The government, there was obviously the political debate between the two sides in our country was high. And I was actually advising a member of the House at the time. And I remember this decision, we were having this discussion about TARP, Troubled Asset Relief. And I said to him, I said, you have to vote for this thing. He said, well, I can't vote for this thing because, my political leanings are against all the government intervention and so forth. And I said, you don't understand. There is no banking system, fractional reserve banking system. I want you to go home and I want you to watch It's a Wonderful Life with Jimmy Stewart. And then I don't have time to watch a movie, Herb. You're going to have to explain it to me. So we went through this big explanation, and it was just dead silent on the phone. He said, Herb, nobody in the House understands that. And I mean nobody. That's how bad it was. It took 18 months to get that, or 12 months to get the TARP even passed. Remember, it failed, and then it came back in November, and it was passed of 08. And it took another period of time. Took 18 months to get the PPIP, which is the Public-Private Investment Partnership, passed. That passed in March of 09. The market kind of bottomed in November, and it kind of ground a little bit lower through March. And March of 09 is when it really started to take off. That was the totality of the stimulus, of the, obviously the Fed cut rates and everything as well. But compare that to 2020, which is where we are now in the Corona crisis. So we get this information, and immediately the Fed cuts interest rates. They don't even wait for the meeting. They did 2 series of massive cuts without waiting for their actual board meeting to do it. So that was a positive. The Fed made $1.5 trillion in repurchase money, which basically means you can bring your bonds, they'll loan you cash on them. 1.5 trillion they brought to bear immediately. They announced $700 billion in quantitative easing, which is them going into the market and essentially printing money, printing cash. Now, they do take bonds for that, so they print the money, buy the bonds, they hold the bonds, the cash goes into circulation. is to try to prevent deflationary pressures. They immediately removed the $700 billion cap that they had put on at first. Then they went and they established a corporate credit facility and a term asset-backed, so it's backed by mortgages and that kind of thing, loan facility to facilitate liquidity in those markets. Because what you see is those markets completely rolled over and lost their bids. I'll bring a little chart back over here just for fun. This is LQD. This is a big giant corporate investment grade corporate bond exchange traded fund or ETF. And normally when the equity markets go down, bonds go up. Well, you can see this went from 134 down to 105 in a matter of a couple of days. So that's a bond fund, corporate investment grade, dropping 25% in 3 days. That told you that the markets were essentially broken. The only advice I could give our investors at that time was you can't be a seller under any circumstances. You have to treat these markets as if they are closed until such time as they begin to function normally again. And you can see when the Fed started making their announcements of what they were doing here in the March 19th, 20th, and so forth, you can see they've begun to heal. Illustrative of just how bad it was, this is a mortgage-backed securities ETF, mortgages that are generally issued by agencies, so they have this implied guarantee of the federal government. Even they went from, you can see $54 a share down to 51. Now, okay, you say that's only 6 or 7%, but this is 6 or 7% in a matter of days in nearly guaranteed principal securities, which make up the holdings in here. So it was a really crazy time, and that's why the Fed has done really so much. In addition to those two facilities, they restarted a commercial paper and a dealer credit facility from '08. The House, Senate, President signed a little $8.3 billion phase one stimulus on March 6th. That was 31 days ago. Since then, it passed a $1.3 trillion phase two stimulus just a week later on March 13th. So this already has eclipsed everything that was done in the financial crisis. Add on to that the $2 trillion package passed on March 26th. And $50 billion of state of emergency funds that the president has the authority to release from the federal government. If you look at the balance sheet of the federal government, it's fascinating to do sometime. You can see all these little basic rainy day funds, trust funds we have for all different agencies, and it's a smart thing to do. Like your HOA has a reserve, your federal government has lots of reserve funds. And they released $50 billion at a state of emergency. The Secretary of the Treasury said, hold off on paying the April 15th taxes until July 15th. This will keep the money circulating longer, so that'll have a modest stimulative effect. The International Monetary Fund has already made $50 billion in loans. They've got $1 trillion behind it, ready to go to loan to other countries. World Bank has made $12 billion in loans, and pretty much every G20 country and beyond has announced both fiscal and monetary stimulative measures. Now, in normal times, you couldn't do this because it would be inflationary. It would devalue currencies. There's all kinds of negative externalities or issues associated with just printing money and borrowing money like crazy as a country. The U.S. is in a unique position, the only country in the world that has what's known as the reserve currency status. So we essentially can kind of get away with it, for lack of a better term, and that's kind of where we are now. In that $2 trillion relief bill, we've got obviously expanded unemployment insurance. We cover now freelance workers, additional benefits for healthcare providers. We've replenished the unemployment funds of all the states through this. We know about the payments, the cash payments to individuals. I've got 2 kids in their 20s. They are very excited to get their payment. And they said, what should we do, Dad? Should we invest it? I said, no, I really think the best thing you could do is to spend it right now. I think the economy needs you to be spending your money. And they were really happy about that. Unemployment benefits are up by an extra $600 a week for up to 4 more months. And then this $350 billion in the small business loans to cover payroll, net, utilities, et cetera, forgivable. So it's essentially just a grant. The idea is rather than lay the people off and then we pay them through the unemployment program, don't lay them off. We pay you through there so that you can restart more quickly. I mean, I gotta say, I mean, there's all kinds of danger in taking on $2 trillion in debt. But I do think that this was pretty well thought out, and I have to give credit. I think this was the Treasury Secretary. The idea of trying to prevent the layoffs to accelerate the restart. We don't know if it'll work, of course, but I think, and I imagine there's some people on this call or with big law firms that certainly wouldn't be eligible. But those of you that are smaller law firms, you might well be eligible for this. I know some of the investment advisory firms that we work for are doing that. Another $500 billion to allow the Treasury to make loans to bigger businesses, $17 billion for national security, airlines industry, air cargo industry, and then grants to healthcare providers, $16 billion to restock the federal stockpile of medical equipment that's obviously being used and depleted. That's what it's intended for. And it keeps going. Match more money for Medicaid. That's the state program. Delayed hospital closures. Hospitals that were scheduled to go away are no longer going away for the time being, and increasing the payments to those hospitals and big payments of $150 billion to state and local governments to handle their costs associated with handling this situation. I know, everybody's got a county health department that is strained and stressed and working on this situation, so they're going to be compensated or relieved of getting that done, at least financially speaking. So that's kind of the state of the economy, the state of the response. And now I want to talk about, okay, the markets. 2 weeks ago, the equity markets, S&P 500, very, very oversold. Now, in December, I get from all of my main competitors, we all kind of do, we all share your outlook for the year, right? So we've got stacks of these. I've got BlackRock, Merrill, Morgan, you name it, my firm, Cantor Fitzgerald. We've got our economic outlook for the year, where we think markets will be, employment, GDP, what are the problems, what are the landmines. And I keep them like my credenza, and I keep them there all year. I want to see who's getting it right. It's kind of fun. And they're gone. I threw them away because, of course, nobody, including yours truly, predicted a global pandemic. Not predictable. I can tell you as an economist, if you have that model, let me know. But couldn't predict it. And so the markets today are trading on one thing and one thing only, and that is this curve. I'll give you an example. I get an alert on my system every time an economic data point is released. So this was the jobs opening report was released this morning. Well, it says here that there's 6.9 million job openings in the United States. There's not 6.9 million job openings. The data is obsolete before it's even reported. Consumer credit for the month of February, it rose 22 billion. It was expected to rise 12 billion. Normally, that would be a market positive event. Oh my, that means consumers are spending. Well, that's February, it might as well be February of 1972, the way things are going. So it's really all about that virus. So we have to throw out literally all of our estimates and models, et cetera. One of the things, if you're into this stuff like I am and you want to watch it, is watch something known as volatility. I'm going to bring this back for a second. There's something called the VIX index or volatility index. You can find it on the CBOE's website. It's online. I think even Google Finance and Yahoo Finance have it. I'm going to graph it for you. It reached a level of 81. You say, well, that's not that significant. It's incredibly significant because you can see down here is about 15. This is where it had been for the better part of a year. If I max this chart out, the only other time we were here was during the global financial crisis. Now, this is a quarterly chart, so it actually got to this up in this 80 level here. Let me do a little custom here for you to show you just how bad this was back then and how it got today. This is volatility. Spikes are when there's fear in the markets, Late 18, the market was crashing a little bit. We got up to 36. Nothing like the 83 level of just a few weeks ago. That compares to the failure of Lehman Brothers, the failure of Bear Stearns, and the complete insolvency of the global financial system. So markets were truly, truly in a panic mode. Here's the good news. We'll just do a year-to-date chart. That fear level, and that's measured as the premium you have to pay for protection in the put markets on the S&P, that premium level has gone from basically St. Patty's Day, March 16th, from 82, and you can see down here we closed today at 46. That's very significant improvement and suggests that the markets are calming and perhaps, just perhaps, even bottoming. There's no way to know for sure if we hit the bottom, but there's the S&P 500. That right there, 2230, that was a week after the VIX peaked. So after the fear peaked, the market went down a little bit more. Same pattern as we saw in late 08 into early 09, but in a shorter time frame. And here we are today, up a little bit. Up, you can see, I guess we're still open. It's 1230. We're up about another 9 points here to 2673. So was this the bottom? We don't know. Could we test it? Yes, we could. But it does appear that things are sort of getting better. The question is how quickly will the economy come back? Still, at that very low level of the S&P 500, we think they were extremely oversold, overdoing it, and pricing in at about a 60% decline in corporate profits. To put that in perspective, corporate profits only declined about 46% over 5 quarters of the global financial crisis. So corporate profits to go down 60% in a crisis, which from an economic standpoint, you had a systemic issue back then. This is a very transitory issue. It is a bigger immediate slowdown, but it should be easier to get restarted. In addition, these declines that would have happened normally, I didn't run out and sell my assets the minute I heard about the coronavirus. But there are folks who do. They sell things short. They use computer programs to do it. Use very large blocks of money, and they do it electronically. They do it with leverage, meaning you can turn a $50 or $100 million portfolio into $1 billion for the purposes of a day and controlling and moving assets. And that has had a really outsized negative impact on markets. In the old days, we had rules that prevented short selling except on an uptick in price. Those rules have been gone for about 15 years now. I personally think they should be back, and we would not have experienced as significant of a decline as we did, but that's the way it is. At this point, I expect markets to continue to improve as long as that curve continues to improve and flatten. If we get another wave or another spike, then I think it's easy to say we will get another test down in there. Still, since all the economic data is not worth looking at or talking about anymore, the only thing left to talk about is the virus. And if the curve is flattening, then everybody's going to then focus on earnings. Q1 ended March 31st. Companies are beginning to report mostly next week. That's when you really get into it. We'll get the banks, and then we'll get the tech companies. The earnings for the first quarter won't be that bad. January was good. February was good. The beginning of March was probably even okay the first week. So a lot of orders were in, deliveries were scheduled, and therefore it's all going to be about the guidance on those earnings conference calls that the CEOs give. Are they saying how that Q2 is going to be bad and we'll rebound in 3, or we rebound in 4, or the whole year is going to be bad? Are they going to take excessive write-downs and try to push the envelope from a tax perspective? We just don't know what they're going to do collectively. But I believe now that we've seen a flattening of the curve this week, if that stays, next week it all goes to earnings guidance as opposed to actual earnings itself. So we keep moving along. Recession is going to happen. It's a question of how deep and how long. I'm seeing people say 30% in Q2. And keep in mind, that doesn't mean our economy, the value of our economy decreases by 30%. It means that in the second quarter, if you had that same rate of decline for 4 quarters, then it would be 30%. So that's really about a 9% drop, which if compounded would come out there. 9% off of economic activity in Q2 seems kind of reasonable to me, and that's where you're getting that 30% number, but it's scarier than it actually is, particularly if we do see a quick rebound or a V-shaped recovery later in the year. So as I wrap up here, 2 slides to go. What should you be doing? I don't know anybody's specific situation. Feel free to call on us, call me directly if you'd like. I'm happy to go over that. But first and foremost, the best thing you can do is to just reconfirm whatever your goals are. I'll use myself as an example. I'm 53 years old. I've been buying into the stock market and the bond markets in my 401k and my retirement and everything else since I was 22. So that's a lot of years of buying in. The maximum 401k amount used to be $5,000, $6,000 back then. And I buy in and I buy in and I buy in. If you have said to yourself or to anybody in the past couple of weeks, I've lost X dollars, or I've lost 30% or 25%, you're really not being fair to yourself when you say that. Let me put it in perspective. I brought the S&P 500 back in, and I'm going to grab the top here. The actual high was February 19th, and the actual low was March 23rd. So that high was for one trade, for one tick, for 1 minute on the 19th, and the low was one trade, one tick, 1 minute on the 23rd. I went to my operations team and I said, I want you to find out if we had any investor their account was brand new and we invested everything on one day and it happened to be at that high tick on March 23rd. Of course we didn't. There were some accounts that were invested that day. And I said, even of all the ones invested that day, did any of them sell on March 19th? And by the way, that low was only for about a half an hour. March 23rd rather. That was for about a half an hour. The reality is, of course, nobody had that happen to them. I have been accumulating, and all of you probably have since you got your first job, which mine was 1988. I've been accumulating. Market went down, up, down, and the long trend is up. Now, well, what if I'm in retirement? What about when I retire? Would this be devastating to me? No, it's really not. I'll take my dividends, I'll take my interest, and I might sell a couple of shares out of my portfolio every month to get that amount I need to live on in retirement. But it won't amount to more than 1/3%, maybe 0.5% at the high end on a monthly basis. If that's the case, again, this big drop is not all that meaningful. What is meaningful is if, as an investor, you don't recognize that and all you see is I lost 30% or I lost $1 million or 500,000. And we get a lot of calls like that, and they're wrong, but our fight or flight in our DNA, our emotion is so powerful, it's difficult to prevent people from succumbing to that nervous energy. And that nervous energy is the greatest destroyer of wealth. In my 33 years of managing money, I can tell you, there were those handful of investors of mine who panicked and sold and didn't take my advice at the bottom of the financial crisis in 2008. And of course, once they left and they were gone and they couldn't make that back up. They waited years before they got back in the market. And we've had a handful that have certainly in the last 2 weeks done the same thing. And of course, they already regret it because of this big rally. You have to recognize as an investor that drops are normal. They're no fun, but they're part of being there. It's kind of like, playing football. Football is great, but it doesn't feel good when you get hit. That's the best example I can give. So the key for an investor is just rebalance. If your strategic target is 50-50 and your stocks are down and your bonds are up, so it's 55-45, just rebalance it to 50-50 and keep doing it and doing it and doing it every time the market makes a big leg up or a big leg down. And at the end, when you're ready for you to retire, you'll be fine. Of course, don't forget you need 6 months of cash liquidity in a savings account or CD or a money market just to hold you through times where you might need it and not be forced to sell into a down market. Lastly, what are we doing as a firm? What have we been doing? Well, we have this tactical view that bonds are just incredibly overvalued. If the Fed is buying and buying aggressively, there's no new buyer left to come on the scene to drive prices higher. Therefore, bonds, we think the real return after inflation over the next decade will be negative. And that's kind of their plan. They want to force you into risk assets, i.e. stocks. So we believe that we have to be overweighted in stocks and ride through this scenario. We believe these market corrections, bears, are temporary. They'll always be reversed. Even if we have to monetize it all, they're going to be reversed on a nominal basis. We can't predict the exact bottom. Could have been March 23rd, don't know for sure yet. And whenever markets decline, we use it to do that rebalance that I discussed and try to capture shares on the downside. We did it on March 23rd in our client accounts, waiting to see if the market goes down any further. We will do it again if that's the case. And then finally, we want to identify what we call opportunistic elements. So that could be an industry or a sector or a country or an industry that's oversold. Two biggest examples I can give you right now is the hotel business, Marriott, Hilton Worldwide, and Hyatt. Extraordinarily oversold, have significant real assets in the management contracts and in the properties, in the case where they own properties. Significant potential for a rebound if they can get through it, get the capitalization right, and get the balance sheets right. And the other one, of course, is airlines, systemically important to the nation. Question is, what will be the form of the assistance? Will it completely harm the existing shareholders, sort of wipe them out, or will it go pari passu with them? But we did make a little nibble here on March 6th and again on March 23rd into a JETS, which is an airline ETF, buys Delta, Southwest, United. We are very patient. We did this in 2008 with home builders, and we're very richly rewarded as a firm. So we think we'll be rewarded again with the airlines at this point. So I went about 35 minutes. Thank you all for allowing me to do that. If you can't tell, I like it. I like talking about it. I wish it wasn't the topic, though. I wish we were just talking about how great the economy was. If you want to follow any of my stuff and you're on the Twitter, you can follow me at ETF_strategist. If on LinkedIn, you can follow Efficient Market Advisor, but really you can just follow me, Herb Morgan. You're welcome to call us or email me if you have an interest in discussing anything. Thank you all. Be safe.